Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within the corporate world. And today we are about to decode a very interesting move by Jefferson Capital, Incorporated, a company that sometimes likes to make its investors sweat a little bit. We've got a current report here on Form 8K detailing the completion of a pretty significant acquisition. It sounds like this company has been busy expanding its reach, and we're here to break down exactly what that means for investors and for the company itself. Before we dive in, if you are like me and you love getting the real lowdown on what companies are doing without all the jargon, make sure to hit that subscribe button. And if you want to chat about these findings with other like-minded folks, our Discord community link is in the description below. So Jefferson Capital Incorporated, sometimes traded as JCAP if you are following it on the stock market, has officially completed a portfolio acquisition. Think of it like buying a collection of assets that generate income. This deal happened on the 4th of December of 2025. They acquired credit card assets from a company called Bluestem. Now here is a key detail: they are not looking to start new credit card accounts through this Bluestem platform, nor did they buy any of Bluestem's retail operations or physical assets. This means they are focused on the existing pool of credit card debt, not the customer-facing business, which is an interesting strategic choice. Let's talk numbers, because this is where the story really gets interesting. The cost of acquiring this collection of credit card assets was a hefty $196.1 million. That is a lot of money. But here is the kicker. Jefferson Capital Inc. estimates that they will collect a total of $310.0 million from these acquired credit card debts. Now that is a significant premium. On the surface, this looks like a very profitable deal. If their estimates hold true, they are looking at a profit of over $110 million before accounting for any expenses related to servicing these debts or any potential defaults that might occur. It's like buying a bunch of IaaS for less than what you expect to get back. Just a quick reminder for context: Jefferson Capital Incorporated has its common stock traded on the Nasdaq Global Select Market under the ticker symbol JCAP. This acquisition is a concrete step in their business strategy. The filing also touches on various conditions for how this report is being submitted, but frankly for us watching the stock price and the company's performance, those checkboxes are less important than what the company is actually doing. They've also given us a press release as Exhibit 99.1, which details the closing of this acquisition. Usually these press releases are crafted to put the best possible spin on things, so it is always a good idea to look at the raw numbers in the filing itself and then supplement with the press release for the official company narrative. And we see Christo Realov, the Chief Financial Officer, is signing off on this report. Always good to see leadership confirmations. Now let's put on our investor hats and really think about this. Jefferson Capital Inc. is a company that deals with credit and capital, so buying portfolios of credit card assets makes perfect sense for their core business. They are essentially buying future revenue streams. The fact that they are aiming for a significant positive spread between the purchase price and the estimated collections is a strong indicator that they believe they can manage these assets effectively and profitably. However, there are always risks in any acquisition. The biggest risk here is the accuracy of their collection estimates. Economic downturns or changes in consumer behavior could mean that fewer people pay back their debts than projected. Also, the cost of managing these assets, whether it is through technology or personnel, needs to be factored in. If their servicing costs are higher than anticipated, that $110 million potential profit could shrink considerably. Looking at their strategy, they are focusing on acquiring existing debt rather than originating new loans. This can be a less risky approach as the performance of the assets is already somewhat established. It is a more mature business model compared to trying to build a customer base from scratch in a competitive credit card market. So what does this mean for Jefferson Capital Incorporated? On the one hand, this acquisition appears to be a financially sound move, a strategic play to acquire income-generating assets at a favorable price. It signals a commitment to their core business. On the other hand, the success hinges on their ability to accurately predict and manage future collections and expenses. This is not a slam dunk yet, it is a calculated bet. In conclusion, Jefferson Capital Incorporated seems to be making a solid strategic acquisition that should boost their revenue potential. The key will be execution. Can they collect on those estimated $310 million efficiently and profitably? It is a big play, and investors will be watching closely to see if the numbers bear out the optimism. Alright, that is our breakdown of Jefferson Capital Incorporated's latest move. What do you think about this acquisition strategy? Are they playing it smart, or is there a hidden risk here? Let me know your take in the comments below. If you found this analysis helpful, give this video a thumbs up and don't forget to subscribe for more corporate deep dives. And seriously, check out our Discord community if you want to engage more with these insights. Thanks for watching, and we will see you in the next one on Corporate Decoder.